Um, we were, there we go. Now we're back live on LinkedIn. Perfect.
Okay, good.
Sorry about that, everyone who's paying attention. Let's go back to, we were talking about the March-May.
Yeah,
And
I think it's kind of interesting to see that March-May, from a spread standpoint, hasn't necessarily made a new high yet. It's close. And, if this is truly going to be a parabolic type market where we continue to surge higher, then I would think this March-May has the ability to break out above 120 and start to widen out. If it's the same old story, similar to the last three expirations, then ultimately you should start to see this collapse in as we get closer to month end. We'll go over some of the dynamics as far as open interest, but I'm not. To me, this spread isn't as obvious as it was a week or 2 weeks ago. Right now, I'll jump. Yeah, I'm
I
sorry. Go ahead,
definitely,
Mike.
I want to point out once again, it's February 15th. February's a short month. You're going to, 3 days, 2 to 3 days less. You've got that March going to expire in 28 days. So this is the time where March becomes less of a futures contract every day and more of a cash contract. So this is where those spreads can do some pretty strange things. It could take off or it could collapse.
Yeah, and I think the reality is you could see a little bit of both. Um, just because of the illiquidity here and all the limit moves we've had, the spread certainly can do some wild things here. I'll jump. So the other interesting part of the spread structure is if you look at the May July is traded out to this 103 area. So it's kind of interesting that this May July contract has made a new high now, and it was interesting to see yesterday. The March-May was in the 93.70 area, and then you had May-July up in that 102 area, where May-July was almost the leading spread as far as widening versus the March-May. It's a technicality to who is in doing what on any given day, but that, the idea that somebody wants to front spread May-July, like I want your crystal ball. I want your ability to be to forecast, to have that kind of confidence versus the March-May. The reality is if we're going to go higher, then March-May should lead the charge to the upside versus the May-July.
This is true. This is very true. All right, that's perfect. I was going to say, let's go to the open interest.
Yeah, so here's a week ago, Mike, 23.94. You can see stair step down from March, May, July. Fast forward here, March is that liquidating contract. So again, you can see we've gone from just under 2,400 open interest to 2,574. March is losing at the benefit of everything else gaining here. So you've got, forward buying, you've got mill inventory hedging coming into these back months, which is good. I mean, you're building open interest, and that's what you want to see. But March, from here on out, is going to continue to be this liquidating contract, and you're going to see the build everywhere else.
Absolutely. All right.
So here's CFTC.
My favorite.
Yeah. And again, we all know here's the managed money component. At one point, these longs were over 700. They're basically have been knocked in half. When you look at the commercials, you've kind of a wash here between commercial longs, commercial shorts. The big number that stands out is, again, this is as of last Tuesday. These other reportable shorts increased 141. So you've got a net swing here of 170 contracts, which I think is interesting. And then the other big one that stands out, you've got a lot of speculative small longs in this market right now. Almost 400 extra longs versus the non-reportable shorts. So this is something to watch if the pattern changes. These are typically your margin call, get pushed out on any weakness. Um, I'm not sure if anything jumps out to you here, Mike.
Well, two things jump out to me, and it's on the commercial end. Um, Here's what we know: these are great prices for the mills. The mills are making a lot of money, and I think the mills are extremely comfortable with hedging, even at these prices. Um, I mean, moving higher from here is a territory we haven't been very often, but this is starting to feel pretty comfortable. And then I talk about feeling comfortable. The long position, the commercial longs, that shows me that the the buy side is used to these prices and they're comfortable with them. They're still going to be able to make money because they can pass this cost through to the end user and consumer. Um, so I just look at the equilibrium in the pretty close to equilibrium in the commercial shorts and longs.
Yeah.
So and then I am surprised actually by the long position in the small non-reportables. Um, One thing there is that is fickle money. Those guys will move fast. So it doesn't bode real well for the not going to a limit. Um, we've seen when this thing goes to a limit, not much happens, and we can move $200 without a whole lot of trading happening.
Yeah, no, I think that's those are all valid points. Let's see here. So here's total open interest. We haven't looked at this one in a couple of weeks. You can see we're gradually starting to build, and seasonally, this is kind of when we do get this inventory build in anticipation of spring kickoff here. So yeah, obviously we're dragging underneath, but we're still in that inventory build structure, which is a positive thing. Um, we talked about this to start the show, Mike. Here's your volatility. Here's implied volatility versus the 5-year average, and just monstrous. I mean, you see it in the options every day, but our implied volatility in lumber is just historically massive right now. And when you have all these limit moves, it just fuels the illiquidity. It fuels the volatility. And I'll jump to the next chart here. This is from more research. This ranks all commodities, and lumber is king of volatility here. You still have obviously, along with euro dollars here, but you can even markets like crude oil or RBOB because of the Ukrainian geopolitical type stuff. You can see even markets like that, even markets like the equity markets are still lagging behind lumber. Lumber is just massive volatility, which is a great thing if you're on the right side. If you're on the wrong side, it can be extremely painful, to say the least.
Yep. All right. Why don't we segue into kind of what the overall topic for today is, and that's the trading strategy. Um, Although, what I'd like you to bring up, Greg, is once again, CME adjusted the margin requirements.
Yeah, so just so people are aware, we've actually had 2 increases in less than a week now. So this is the first increase. This was done this came out Thursday night, implemented on Friday. And you can see if you're a spec, and the non-HRP are the spec trader. So non-HRP month 1 here is March. So you went from 6,600 a week ago to 8,250. Fast forward to today, you're going from 8,250 up to 9,500. I'm sorry, 9,500 to 10,000, which is just a massive increase in less than a week. You're going to go from 6,600 to close to $10,000, depending on the contract. So this is, the CME has the one size fits all approach, and they like to aim bazookas at things. And okay, we're going to rein in the volatility by increasing margins. And in a market like this, boy, that's a tough one. I think you just push more people, unfortunately, to the sidelines, and the haves that can absorb this ultimately have more control in trading this market versus the ones that actually get impacted by higher margins are more likely to go to the sidelines here.
Yeah. So let's talk about the playing field as it is today. Um, if you're a trader, what are the knowns? Well, the first thing we know is margins have just increased by 60%. Is that about right? Whatever. They're $10,000. The last thing you want to do as a trader is get pushed out of a trade because you don't have enough money to support the trade. So it's very important to be cognizant of the capital in your account and trade within your bounds. That being said, the volatility is extremely high, and this volatility is causing limit moves, which once again takes you out of the trade because there is no trading going on. So, what's paramount is sizing up your position and sizing up your entry and exit points. So, it's plan your trade. Know what what your risk tolerance is going to be, and you can't second guess when you hit an exit point, whether it's an exit on a profit or an exit on a loss. Take the exit, and then don't look back because it's very easy if you exit a trade and you look and you're like, wow, I could have made more money, and 2 days later you're like, oh wow, I'm really glad I got out of that trade. So you can see where market movements can really mess with your mind. um, I found, throughout my trading career, yeah, you can be a little upset for just a very short period of time, but if you've done the trade that you planned, um, everybody would, hindsight's always 2020.
Yeah, there's
So
the old saying, and you know this, Mike. Never, you'll never go broke taking profits. And I think it's okay when you're on the right side of a lumber trade. You're certainly in rarefied air, given this volatility, that there are a lot of people on the wrong side of these trades here. So just be cognizant of the fact, like you said, have a plan in mind. You know, whether it's risk management, you're truly a bona fide hedger. If you're a speculator, that's fine, but at least understand the risk to reward in these trades, and execute your plan. And, I'm a big fan of having contingency plans, contingency parameters in place where, okay, this is what I think it should do. If it doesn't do this, how am I going to react? And that's something that's kind of revisited on a daily, on a weekly basis in a market like this with this extreme volatility, that what exists today doesn't necessarily exist tomorrow in a market like lumber. So execute your plan, have a plan, and execute your plan. And then the other big thing I can't stress enough is do not assume the industry's risk. I think this is the type of market where everybody wants to pass the hot potato here and have somebody assume the risk for them. At the end of this, be very cognizant of what the reward is versus the risk, especially if you're assuming somebody else's risk. Because at the end of the day, when this ends, the higher we go, the more likely it is to end badly. And at the end of the day, the mills do not absorb this misery, and that if they have to cut their prices by $300, $500, $1,000, when you're trading at $1,200, $1,300 plus dollars, to go back to $700, $800, $1,000, if you're a sawmill, you still have fixed cost, or you still have finite cost. You're still highly profitable. It's the other side that ultimately absorbs this insane risk. So at least just lay out the risk to reward, and have some kind of contingency plan in place, whether it's in the form of futures or options, but at least understand that there is risk, and that risk grows the higher we go here.
right, and risk is not a bad word. It just is a
No.
description. It's a description of a scenario. So you know, if you have a healthy respect for risk and you factor it into your business in the right way, it can be extremely profitable, or
Yeah, I absolutely agree.
or it can protect your profits.
And that's the key here, is that it's been one heck of a start for this industry in 2022. you don't want to have to worry about giving everything back at some point. So at least understand that there is risk. Again, you've done well so far. Don't give it all back here on things you can't control versus what you can control. And what you can control is pure definition. Where is my risk in this market today?
Yep. Just one other thing I'd like to point out. We had that strong dip at the beginning of February there. Um,
Hmm.
that didn't happen for no reason. That happened because as we broke lower, the buyers went away. Now, look, they came right back in, but what that tells me is that if we did that once, it's possible for us to go back down there. Now,
And Mike, I think you hit the nail on the head in that you're going to see weakness materialize in futures first. Cash, the mills have their order files. They'll go to the sidelines. They'll sit there and play that waiting game to see what materializes. You will see that weakness develop first in futures. And that's where you're going to see the reaction to the downside first. And it's not going to have to make sense where we all know, especially after the discounts futures traded to cash, you can see something go from even money in March or May to trade at 100, 150, 200, $250 discount before you start to see the real cracks develop in cash, where cash will be the last market to break. Futures will be that leading indicator to the downside ultimately when this rolls over.
and I'm, I'm going to give fair time to both sides. We've seen $1,700 before.
Sure,
So,
sure.
you know, what what was 2 years ago unheard of. Well, we've seen it before. So as we sit here today, there's no reason it can't go to 1,700. Um, but in recent times, we've seen it drop $300 from here.
Yeah, and
Um,
again, Mike, this all goes back to, and I think that's again, where's your risk? Is the risk in this market going to $1,700, or is the risk in this market going back to $800? And that's where each individual trader, each individual company needs to define what's going to be more painful for me, not the industry. What's going to be more painful for me? Is it a move to 1,700? Or is it a move to 800? But to say that you can't see either of those numbers, given this volatility, you could see you could see either of those numbers, you could see both of those numbers, and you could do it in a very short duration just because of the sheer volatility that exists.
yep. And I would keep my eye on who has the wood in the supply chain in the wholesale side. If if the wood is in the fast money hands, i.e. the office wholesalers or some type of public distribution yard user, they've got fast money, and they, like you pointed out, the mill can drop their price 300. You know, the mill has not reckless abandon. What I mean? The mill basically has a flat production curve. They have to sell no matter what, right? So if you see the non-mill suppliers um, moving quick and trying to sell, I would be careful.
Yeah.
Uh, but like right now, yesterday we had a mill listing on our platform in the morning, and by 9 o'clock they had pulled their offers because the product had gotten sold. Um, so right now it seems as though the fast money is in hitting the gas pedal, trying to move the market higher.
Yeah, and again, this dovetails into, run through the rail car stats real quickly here.
Okay.
You're starting to see a little bit of an improvement with CN, car velocity, miles per day. Again, seasonally, the bottom still lies in the next couple of weeks here. Jump forward. Okay, here's your Canada rail car statistics, and you can see, again, from a timing standpoint versus the last 2 years, we're starting to get into that timing, the inefficiency of where we bottomed out the last 2 years. But I think this becomes the dictating factor in that most BC mills right now are getting somewhere in the neighborhood of 30 to maybe 40% of their normalized rail car allocation. It should start to improve here, but again, this just is fueling this supply constraint where, again, it just have complete inefficiencies with the CN. versus once you cross the border, look, there are issues in transporting goods all over the place, but you're not seeing, and again, who knows what this will look like in 2-3 weeks. But again, when you look at what's going on in Canada versus what's going on in the US, it seems to be much better once it crosses the border. It's just getting that wood across the border that seems to be easier said than done. And, what amazes me is that this seems to be a year after year occurrence now with the CN. Since 2018, every year it seems to be something historically. Weather would be a negative thing for pricing. Now, weather this time of the year is a positive thing because of the inefficiencies of CN, where
It is.
I hate let's not kid ourselves. They're basically a monopoly, and every year this time of the year they seem to be a dumpster fire, and this year is no different.
Now, the one thing I will point out when it comes to supply and demand, there's a dislocation of the supply, not in the same geographic region as the demand, which can change prices. But there's no mills shutting down because of it. The supply is still being produced. It's just in the wrong spots. And like water, it will balance itself out eventually.
Yeah, yeah. And then just to end, Mike, on the idea of have a plan. Again, this is pricing over the histogram over the last 2 years, and again, what percent of the time do you spend above these thresholds? And over the last 2 years, 16% of the time is spent at $1,000 or greater. Less than 1% of the time is spent at 1,500 or greater. That doesn't mean you can't expand this and these percentages increase, but just from a risk to reward standpoint, why are we at these numbers? What's the underlying fundamental reason? Is it demand driven? Is it supply driven? So at least understand the ramifications of, again, where your risk is and the underlying fundamentals that to support these higher numbers, to support $1,000 or greater, you're probably going to need to see underlying fundamental demand strength to justify that. And with all the headwinds facing housing, once you get beyond Q1 into Q2 and beyond, how realistic is that? So again, just at least understand risk to reward right now because it's massive on both sides, or it has that potential to be.
For sure. All right, let's wrap it up. We'll get together next Tuesday. Until then, trade your plan your trade, or plan your trade, trade your plan. Be safe. And any questions, of course, Greg Kuda and myself are always available and would be more than happy to talk through any ideas that you may have.
Yeah, I appreciate it. Thanks, Mike. Have a great day.
All right. Take care.